What if I told you? The next trillion-dollar industry isn't on Earth. It's above us. Right now, as you're watching this video, satellites are beaming GPS signals to your phone. Satellites are delivering this very video to your screen. Satellites are tracking hurricanes before they hit land. Satellites are connecting ships in the middle of the Pacific Ocean. We don't talk about it much, but space is already deeply woven into our everyday lives. And the companies behind it? Some of them are publicly traded. You can buy a piece of them right now. But here's the thing. Space stocks are complicated. Some are massive, stable, cash-generating businesses. Others are unprofitable startups burning through money every quarter. And some are pure speculation. So today we're breaking it all down. What are space stocks? How do they make money? Who are the biggest players? What are the risks? And most importantly, are they actually worth investing in, or is it just hype? I'm going to give you a full, honest breakdown. No fluff, no pump, just the facts, so you can make your own informed decision. Let's get into it. Part 1. What are space stocks? Before we get into specific companies, let's get clear on what we actually mean when we say space stocks. Space stocks are publicly traded companies that generate revenue from activities related to the space economy. That's a broad definition, because the space economy itself is broad. It covers rocket launches and launch services, it covers satellites, building them, operating them, and leasing bandwidth on them. It covers space-based internet connectivity. It covers military and defense systems in orbit. And yes, it even covers space tourism. Now here's a framing that I find really useful. Think about space the way you'd think about the early internet. Back in the 1990s. In the 90s, companies were laying cables under the ocean, building servers, creating infrastructure. It cost enormous amounts of capital. Most companies weren't profitable, but the people who understood what was being built and invested early, they were eventually rewarded massively. Space is at a similar moment right now. Infrastructure is being built. Satellites are being launched by the thousands. Rockets are getting cheaper and more reusable. The plumbing of the space economy is going in. The big difference? Space is even more capital intensive. A rocket launch costs tens of millions of dollars. A satellite constellation can cost billions. And a launch failure can wipe out years of progress in seconds. That's why many pure-play space companies are still far from profitable. They're in build mode. They're spending now, betting on revenue later. And that's what makes space stocks a fascinating but genuinely tricky investment category. You've got companies at completely different stages. Some are mature businesses with steady cash flows, and others are early-stage ventures that are years away from profitability. Knowing the difference is everything. Part 2. Satellite companies. Let's start with the backbone of the space economy. Satellite companies. If you're looking for space exposure with more stability, this is probably where you want to look. Satellite operators generate recurring revenue from long-term contracts. Think of it like a toll road in the sky. Once the satellites are up, companies pay to use the bandwidth. Iridium Communications, IRDM. Iridium operates one of the most unique satellite networks on the planet, a constellation of 66 low Earth orbit satellites that provides true global coverage. And I mean truly global, even the North Pole. Their customers include maritime operators, ships at sea, aviation companies, aircraft in the sky, government agencies, and defense clients. These are not consumer subscribers who cancel when they're unhappy. These are long-term B2B and government contracts. Iridium also has a growing partnership with consumer devices. Apple has integrated Iridium satellite connectivity into recent iPhones for emergency SOS. That's a massive distribution channel opening up. If you want a space stock that behaves more like a telecom utility than a speculative tech stock, Iridium is one worth studying. Globalstar GSAT. Globalstar also provides satellite connectivity, with a slightly different network structure. They've had a significant partnership with Apple as well, providing infrastructure for satellite features on iOS devices. Globalstar has historically been more volatile and financially complex than Iridium. It carried substantial debt and operated at a loss for long periods. But the Apple relationship has changed the narrative for some investors. This is one where you need to do your homework on the balance sheet before jumping in. SESSA. SES is one of the largest satellite operators in the world. a Luxembourg-based company with a massive fleet of geostationary and medium Earth orbit satellites. They provide bandwidth to broadcasters, telecom companies, and governments around the world. This is a mature, global business with diversified revenue streams, less exciting than some of the newer names, but far more financially grounded. The satellite sector as a whole is interesting because it generates what investors love most: predictable, recurring revenue. These companies are not just speculative space plays. They are operating businesses with real customers and real cash flows. Part 3. Rocket and Launch Companies. Now we're getting into the high-risk, high-reward side of the space economy, rocket and launch companies. Let's address the elephant in the room immediately: SpaceX. The most famous rocket company on the planet, the company that has genuinely transformed the economics of space launch with reusable rockets. SpaceX is private. You cannot buy shares in SpaceX on a public stock exchange. Not yet, anyway. If and when they go public, it will be one of the biggest IPOs in history. But for now, public investors don't have direct access. So what can you actually buy? Rocket Lab, RKLB. Rocket Lab is the most prominent publicly traded pure-play launch company. They operate the Electron rocket, a small launch vehicle designed to put small satellites into orbit quickly and affordably. They've completed dozens of successful launches. But here's what makes Rocket Lab interesting beyond just launches. They've been strategically expanding into space systems, building satellite components, spacecraft, and even entire satellites for customers. They have a larger rocket in development called Neutron. This diversification matters a lot. A company that only launches rockets is exposed to every launch delay, every failure, every competitor. A company that builds satellites and launches them is a more integrated, more defensible business. Rocket Lab is still not profitable on a GAAP basis. It burns cash, but it has a real revenue base and a clear growth strategy. It's high risk, but it's not vaporware. Virgin Galactic/Galactic Holdings. Virgin Galactic occupies a completely different corner of the space market: space tourism. The vision is flying, paying customers to the edge of space for a few minutes of weightlessness and a view of the Earth's curvature. The reality? Virgin Galactic has had an extremely turbulent history. Delays, setbacks, pivots. The stock has been one of the most volatile in the entire space sector. Revenue has been minimal relative to expenses. Space tourism as a business is real. There are people willing to pay hundreds of thousands of dollars for the experience. But the path to scale is long, expensive, and uncertain. If you're looking at this one, treat it as a very high-risk, very speculative position, not a core holding. The broader lesson here is important. Not all space companies are created equal. Some are building real infrastructure with paying customers. Others are building a dream that may take many years, if ever, to become a profitable business. Part 4. Defense and Aerospace Giants. If you want exposure to space but want to sleep at night, this is where many conservative investors look first: the big defense and aerospace conglomerates. These are not pure-play space stocks. Space is just one division of a much larger business. But for investors who want stability, dividends, and government contract visibility alongside space exposure, these companies offer exactly that. Lockheed Martin, LMT. Lockheed Martin is one of the world's largest defense contractors. They build military satellites, space systems, and have contracts with NASA. Their space segment includes GPS satellites, missile defense systems, and deep space exploration missions. Lockheed pays a dividend. It generates substantial free cash flow. It has a massive backlog of government contracts. For investors who want space without speculation, this is the kind of name that shows up in institutional portfolios. Northrop Grumman, NOC. Northrop builds the Antares rocket, used to supply the International Space Station. They're deeply embedded in government space programs, missile systems, and space defense technology. Like Lockheed, this is a massive, diversified defense contractor where space is one important piece: stable, dividend-paying, and tied closely to U.S. government spending. Boeing, BA. Boeing's space story is complex. On one hand, they have significant NASA partnerships, including the Space Launch System, the rocket used for the Artemis moon missions. On the other hand, their Starliner crew capsule has faced repeated technical challenges. Boeing is a much larger, more complex business than just space, and has faced significant issues across its commercial aviation division. It's not a clean space play, but space is part of the picture. The key point about all three of these defense giants: they offer much lower upside than pure-play space companies, but they also offer much lower downside risk. They're not going to zero. They have diversified revenue, government backing, and decades of operating history. It really comes down to what you're after as an investor: upside potential or capital preservation with modest space exposure. Real quick, if you're finding this breakdown useful, hit that like button right now. It genuinely helps this channel grow and tells the algorithm to show this to more people who are trying to learn how to invest smarter. We still have the best part coming: the risks, the valuation trap most people fall into, and whether space stocks actually belong in your portfolio. Let's keep going. Part 5. Why investors are interested in space. So we've looked at the companies, but let's zoom out and talk about the macro case. Why are serious investors paying attention to space at all? The first reason is satellite internet. Companies like Starlink, SpaceX's satellite internet division, have demonstrated that you can deliver broadband quality internet from space to anywhere on Earth. That's a multi-billion-dollar market in underserved regions, on ships, on planes, and in remote areas where traditional fiber will never reach. The second reason is national security. Space is increasingly militarized. GPS jamming, satellite surveillance, anti-satellite weapons. Governments around the world are spending heavily to maintain and defend their orbital assets. That means government contracts, and government contracts mean predictable, long-term revenue for the companies involved. Third, the global space economy is growing. Various projections put the total global space economy reaching well over $1 trillion within the next decade. Launch costs have dropped dramatically thanks to reusable rockets. That lower cost unlocks a wave of new applications that weren't economically viable before. Fourth, data. Satellites generate enormous amounts of data. Earth observation satellites can track commodity supplies. How full are oil tankers? How large is the crop in a given region? This kind of data has value, and there's a growing market for space-based analytics. The macro tailwinds are genuinely real. The question, as always in investing, is how much of that optimism is already priced in. Part 6. The risks and what most people miss. Alright, now for the part most space stock videos skip over: the risks, and they are significant. Risk 1. Launch failures. Rockets blow up. It happens. A single launch failure can destroy a satellite worth hundreds of millions of dollars, set a company back months or years, damage customer relationships, and crater the stock price. This is a physical, irreversible risk that doesn't exist in most industries. Risk 2. Massive cash burn. Many space companies are burning through cash at alarming rates. They raise money, they spend it on rockets and satellites and engineers, they raise more money. As a shareholder, dilution is a constant threat. Every time a company issues new shares to fund operations, your ownership stake gets smaller. Risk 3. Government dependency. A lot of space revenue comes from government contracts, and government priorities change. Budget cuts, political shifts, or a change in administration can meaningfully affect a company's revenue pipeline with very little warning. Risk 4. Competition is intensifying. SpaceX has dramatically lowered the cost of launch. That's great for satellite operators, but it's brutal if you're a launch company trying to compete with SpaceX on price and reliability. Even well-funded competitors are struggling to match SpaceX's cost structure. Risk 5. Valuation traps. This is the one that catches the most retail investors. During periods of enthusiasm, space stocks can trade at astronomical valuations, multiples of revenue with no path to near-term profitability. When sentiment shifts, these stocks can fall 70%, 80%, or more. We saw this clearly in 2021 and 2022. many SPACs that took space companies public at inflated valuations have since collapsed. The excitement around a sector is never a substitute for understanding the fundamentals of the specific company you're buying. Should you invest in space stocks? Here's the honest answer. Space is not a short-term trade. It is a long-term structural theme. If you believe that satellite internet will connect billions of people, if you believe that defense spending in orbit will grow, if you believe that the commercialization of space is a multi-decade trend, then yes, having some exposure to space in a diversified portfolio is not unreasonable. But you need to be selective. The gap between the best and worst space investments is enormous. A mature, dividend-paying defense contractor is a completely different risk profile than an unprofitable small rocket startup. Know what you own. If you want to keep it simple, the defense giants give you stable, diversified space exposure with lower volatility. If you want more upside, companies like Iridium or Rocket Lab offer more direct exposure with more risk, and if you're tempted by the pure speculation plays, size them accordingly. Small position. Money you can afford to lose. Space is genuinely one of the most exciting investment themes of our lifetime, but as with any exciting theme, the hype always runs ahead of the fundamentals. So invest in space because you understand the businesses, not because the rockets look cool on Twitter. Because here's the irony of the space industry. No matter how high they fly, gravity still exists. If you found this video valuable, subscribe for more breakdowns like this every week. Drop a comment below. I want to know, are you bullish or bearish on space stocks right now? I'll see you in the next one.